What are granny shots in investing? The term granny shot refers to the underhand free throw technique in basketball. It might not look impressive, but it's highly effective. In investing, granny shots are investment strategies that may not be glamorous, but deliver consistent results over time. Let's compare flashy investment approaches with granny shot strategies. While complex methods might seem impressive, simple approaches often lead to more reliable outcomes. The term was popularized by Charlie Munger, Warren Buffett's business partner, who advocated for simple, proven investment methods rather than flashy, complex strategies that often underperform. Remember that effective investing doesn't need to be complex or flashy. Like the granny shot in basketball, sometimes the most reliable approach isn't the most glamorous one. The term granny shot comes from basketball, where it refers to a specific free throw technique. In basketball, a granny shot is shooting free throws underhand, similar to how a grandmother might throw a ball. While the conventional overhand shot might look more professional, the underhand technique has been statistically proven to be more effective. Rick Barry, an NBA legend, famously used this underhand technique and achieved an impressive 90% free throw success rate. In the context of investing, the term granny shot represents choosing proven, reliable investment methods over trendy or sophisticated approaches that may look impressive but often produce worse results. Core principles of granny shot investing. The first principle is to invest in what you understand. This means avoiding complex investments that you can't easily explain to others. Second, focus on companies with durable competitive advantages, often called economic moats, that protect their profits from competitors. Third, prioritize long-term value over short-term gains. This means ignoring daily market noise and focusing on fundamental business growth. Fourth, maintain a margin of safety by buying assets at prices significantly below your estimated intrinsic value, providing a buffer against errors. Finally, practice patience. Allow time for compounding to work and avoid excessive trading that generates fees and taxes. These principles may seem basic, but they've consistently created more wealth than complex trading algorithms and speculative strategies. Index fund investing is perhaps the ultimate granny shot in the investment world. Index funds are pooled investments that simply track a specific market index, like the S&P 500, without attempting to outperform it. This approach was pioneered by John Bogle, the founder of Vanguard, who revolutionized investing for everyday people. Over long periods, index funds consistently outperform the majority of actively managed funds. The key advantages of index fund investing include low fees, built-in diversification, minimal monitoring requirements, and avoidance of market timing mistakes. One of the biggest advantages is fees. Index funds typically charge around 0.1%, while actively managed funds often charge 1% or more. This difference may seem small, but over 30 years, it can reduce your returns by approximately 25%. Index funds truly are the ultimate granny shot in investing. They're not flashy, but they're consistently effective. Like the granny shot in basketball, they require discipline rather than complexity, and they focus on results rather than style. Just like a granny shot may not look impressive, but consistently puts points on the board, index fund investing delivers reliable results over the long term. Value investing is a classic granny shot approach to building wealth in the stock market. Value investing involves buying companies trading below their intrinsic value and holding them for the long term. This approach was made famous by Benjamin Graham, who wrote The Intelligent Investor, and his most successful student, Warren Buffett, known as the Oracle of Omaha. Let's explore what makes value investing a granny shot strategy. Value investors look for companies trading below their intrinsic value, what they're actually worth based on fundamentals. The strategy is to buy when a stock's market price is significantly below its intrinsic value, providing a margin of safety. This patient approach might not seem exciting during bull markets, but it proves extremely effective over complete market cycles. While value investing might not be as exciting as growth investing during bull markets, it shows remarkable resilience during market downturns. Growth strategies often outperform during bull markets, but value investing typically loses less during downturns and recovers more quickly. This consistent, less volatile performance is why value investing is considered a granny shot strategy, not flashy, but highly effective over time. Value investing offers several key advantages as a granny shot strategy. It provides less volatility than growth strategies with a built-in margin of safety. Value investing delivers superior risk-adjusted returns over full market cycles with a proven track record of long-term success. Just like the reliable granny shot in basketball, value investing may not be flashy, but it gets the job done, scoring consistent returns for patient investors. Dollar cost averaging is a systematic investment approach where you invest fixed amounts at regular intervals regardless of market conditions. Markets naturally fluctuate over time, creating a roller coaster of prices that tempt investors to time their entries and exits. With dollar cost averaging, you invest the same amount regularly, regardless of market prices. Here we're investing $1,000 every 2 months. The magic of dollar cost averaging is that your fixed investment amount automatically buys more shares when prices are low and fewer shares when prices are high. Dollar cost averaging offers several powerful benefits that make it an excellent granny shot investing strategy. By investing on a fixed schedule, dollar cost averaging removes emotional decision-making from your investment process. It prevents the costly mistake of trying to time market bottoms or selling at the wrong time. One of its biggest advantages is automatically buying more shares when prices drop, which lowers your average cost. Research shows dollar cost averaging reduces risk while still delivering excellent long-term results. Perhaps most importantly, it helps create a disciplined investing habit that leads to success over time. Let's compare dollar cost averaging to attempting to time the market. Dollar cost averaging is a consistent, emotion-free approach with a proven track record. It typically results in a lower average cost per share and significantly reduces investor stress. Market timing, on the other hand, is inconsistent and driven by emotions. Studies show most investors who try to time the market end up with higher average costs, poor results, and much higher stress levels. To summarize, dollar cost averaging is a proven granny shot investment strategy. While it lacks the excitement of trying to time market bottoms, research consistently shows it produces excellent long-term results. Just like a granny shot in basketball, dollar cost averaging might not be flashy, but it gets the job done with remarkable consistency. By making regular, consistent investments regardless of market conditions, you remove emotion from the equation and set yourself up for long-term success. Dividend reinvestment is a granny shot strategy that dramatically enhances returns over time. This strategy involves systematically using dividend payments to purchase additional shares instead of taking cash. This creates a powerful wealth-building cycle. You own shares that pay dividends, which you use to buy more shares, leading to more dividends over time. The power of dividend reinvestment becomes clear when we compare growth with and without reinvestment. While regular dividends provide linear returns, reinvested dividends can generate exponential growth through compounding. Historically, dividend reinvestment has contributed significantly to total market returns. Since 1930, about 40% of the S&P 500's total returns came from reinvested dividends. Dividend reinvestment is a perfect granny shot strategy because it's simple to implement, harnesses compound growth automatically, and builds wealth steadily without requiring special skills or timing. Like a consistent free throw shooter, dividend reinvestment may not be flashy, but it delivers reliable results over time. Why do granny shot investment strategies actually work? The answer lies in human behavior. Investors often fall prey to several behavioral biases that hurt their returns. Granny shot investing strategies directly counteract these biases by implementing simple, mechanical approaches. The key difference between granny shots and conventional approaches is that granny shots remove human psychology from the equation. These strategies succeed because they're designed to work with our natural tendencies rather than requiring superhuman discipline. The true power of granny shot investing is that it requires less effort to maintain over time, making it easier for the average investor to succeed.